Are Canadian buyers making a mistake waiting on the sidelines for the interest rates to go down? Well, let's discover that today. Hello, my brilliant home buyers and sellers. This is Faryal, and in today's video, we are going to talk about the market update for the month of October for Greater Toronto area, and we're going to talk what those numbers really mean. And at the end, we are going to reflect on how Canadian home buyers who are waiting on the sidelines right now for the market to shift could be making a mistake. So let's get right into it. First, let's take a look at the numbers. Our sales have declined year over year by 5.8%. However, month over month, they have been steady. Recorded in October, 4,646 sales. The activity hasn't changed much since September. Now, when it comes to new listings, they were up by 38% year over year. Month over month, they declined by 11.44%. To give you a little background here, in the real estate cycle, we usually see an uptick in the market in the spring, and then we see that in the fall. So when it comes to the supply, we were definitely on point following that cycle, following that trend. However, sales didn't keep up with that trend. Now, average prices went up by 3.5% year over year, and they went up by 0.5% month over month. Months of inventory is sitting at just over 2 months, so 2.4, and days on the market remains pretty much the same month over month as well, anywhere between 20 to 30 days. However, if you're someone who is pricing their home correctly, you definitely have a chance to sell your home before that 1 month mark. So what does it all mean? Sales are down year over year and month over month. That is obvious right now that that's due to high interest rates. Of course, many buyers and sellers just don't want to make that move. New listings have gone up. We are definitely seeing more inventory coming in the market, which is helpful to many buyers since we have a bit more options now. And I also see in being in the market, many buyers were hoping that because more inventory is now coming to the market and there's less competition, less buyers out there, that will definitely bring the average prices down. However, that is not the case, and prices are keeping strong month over month, year over year. So why is that? Well, it is because our months of inventory is continuously indicating that we are still in the seller's market. Unless our inventory goes past the 4 months mark, we will remain in the seller's market. So we're still seeing that the supply and demand in our housing market is pretty off. The supply hasn't caught up with the demand. I really want to quickly show you the months of inventory in different regions for you to get an idea what it looks like. So I am going to quickly show you the months of inventory for past 3 months. So you can understand what I'm really talking about. So overall, right now in the Greater Toronto area, we have about starting in August, we had 2.2. And if you look down everywhere else, except in King, everything else is either 2 or below 2. In Toronto, same story. I mean, there's some regions that have 3, like CO1 in August, we saw was a little bit up. Then we go to September, same thing. We stay at 2.2 overall inventory. Again, it's 2.1 Halton region, Burlington, Mississauga. Nothing is over 4 months of inventory. Then we go to October. We had literally just from 2.2, we went up to 2.4. But if you look at all the other regions, I mean, everything is below 4. So that explains to you how and why our prices keep going strong, because our inventory is still pretty low in pretty much everywhere in the Greater Toronto area. Now, I know many of you out there are waiting for the housing market to take a turn, and you also think that the prices will drop in the near future. To be honest, in my personal opinion, that is not going to happen. And this is why. For the housing market to crash, these things need to happen. Number 1 on the list is that our government decides that they will reduce the immigration numbers. So further to my point, let's take a look at quickly what the immigration levels plan look like for the near future. So an article posted on November 8, 2023, so it's very recent. On November 1st, the Immigration, Refugees and Citizenship Canada, IRCC, released the immigration levels plan for 2024 to 2026. And based on that plan, Canada will admit 485,000 new permanent residents in 2024, and then after that 500,000 annually in both each of, I believe what they were trying to say is 2025 and 2026. So it doesn't look like those numbers are coming down anytime soon. But why are they bringing in so many people? Well, they are bringing them in because we need more labor force. According to the article, it says up to 9 million Canadians are expected to retire by 2030. We know that we have a huge baby boomer population and they're going to retire, and we need more people to come in, especially in our construction. We don't have workers available to build and achieve the goal of more housing. Because if you look at over here, it says that an IRCC released the levels plan. It also said that bringing in high numbers of immigrants is to fill those labor market gaps that will help Canada deliver on its national housing strategy. And the housing strategy aims to invest more than $82 billion over the next 10 years to build more houses in Canada. So from what it sounds like to me is that the immigration levels will stay the same at least up until 2024. We don't see that those are coming down. But then also the people who are coming in, we're going to extract some people to work in the construction to help us build more homes. So I guess the pressure on the housing market will pretty much remain the same until 2026, when we have enough numbers to support that labor force. Number two is that supply goes up drastically. Government starts building over 1.5 million homes, and that definitely helps with the demand that's out there. Second point, that supply drastically goes up. So for that, I want you to take a look at the housing starts in Canada's major cities mid-2023 overviews posted by CMHC. This was posted on October 5th, 2023. And according to this, it says that the housing supply only grew by 1% in the first half of 2023 compared to the same period in 2022. So we're definitely seeing that the housing starts are not growing as fast as they should be for us to take off that pressure from the housing market. Now, it also talks about that the factors, of course, that are affecting this slow rate of growth is the stricter borrowing rules, higher construction and labor costs. We don't have enough labor force to meet with that demand, and increased interest rate that are challenges for developers in all 6 major markets. Additionally, construction times have extended by 0.9 months. So construction times have gone up, the construction cost has gone up, the housing supply in biggest cities are growing at a very slow pace. So it all points out to the fact that meeting that number that they've been talking about in the news, that 1.5 million homes need to be built to take off the pressure of the housing market, doesn't seem like it's going to happen in the near future either. Number 3 indicator will be the unemployment rate. Higher the unemployment rate, which means more people are now unemployed and they're unable to afford the monthly mortgage payments, that will definitely decrease the demand as well, which in return will decrease the prices. So the third economic factor is the unemployment rate. When the unemployment rate is going to be high, that means more people are now unemployed and we have less money running in the system, which means the buying power for many people will go down and the demand will go down too. So let's take a look at the trend, what it's showing us. So if we take a look at the graph, we saw that it was pretty much stable all this time until January 2020 hit. And of course, that's when we started to see COVID happen. There's so many things happen, and then the unemployment rate went up quite high, and then after that we started to see it's going down, and it's going down quite a bit. So there's a lot of people who are in the labor force working. Monthly full-time job growth, it's picking up again in August. It actually went pretty high, and then it's pretty much been stable. What the numbers are telling us is that the unemployment rate in Canada was 5.6% as of October 2023, which was up by only 0.1% from the previous month. And the employment rate stood 7.8% below the peak from June 2020, and is below the long run average as well. So we're still seeing a strong economy in terms of our employment, and more people are working. Full-time employment has recovered since reaching a bottom in May 2023. and now stands at a record high. And most of the people who are working in full-time jobs that's gone up is in natural resources, construction, transportation, warehousing, professional and scientific services, business and building services, and education. And things where we see most of the job losses are in agriculture, utilities, manufacturing, trade services, the financial sector, healthcare, information, cultural services, accommodation and food services, and administration. And those are the areas where we keep seeing losses in jobs. And number 4, I believe that people need to start leaving Ontario and move to other provinces, and I don't see that happening either. My 4th point is that people start leaving the province of Ontario and move to other provinces to take the pressure off the housing market and the prices. Well, looking at the numbers right now, the number of immigrants arriving in Canada in 2022 by province or territory of residence. And it looks like Ontario is number 1 on the list. Just alone in 2022, about 227,000 people came to Ontario, and then the next one is British Columbia, and we see pretty much the same situation when it comes to housing over there. And then Quebec is on the list. But anyways, the point over here is that many people who want to come to Canada they come to Ontario. Ontario seems to be very popular. Looking at all of these economic factors, and I showed you all the examples and what really numbers are telling us, they do not point towards a market crash, especially once the interest rates start to go down. I mean, no one can really predict what is going to happen in the future, of course, but for the prices to drop, all of these things that I was mentioning earlier need to come together. Now let's take a look at the numbers for each home type, how they have changed since the peak market, which was last year in 2022 in April. Then the interest rates started to go up, and now what those numbers are looking like in this market. So in front of me is the chart that I've created to show you what the numbers are looking like, comparing it to the peak market, April 2022, to the slow market that we are in of October 2023. So for the detached homes, the average price back in April, you were paying about over 1.6. And now for the same detached home, you are paying about 1.4. That is a price difference of 10.94%, which is a huge number in my personal opinion. Then we have semi-detached home. You were paying for about over 1.2. Average price now for a semi-detached is just over 1.1. And the savings over here are 12.42%. Now keep in mind that this is the market where the interest rate were about just around 4%, and right now we are at the interest rate for about, I would say, over 6%. But also, as I mentioned earlier, you should go check out my video for the mortgage payments. I know not everyone's going to be able to take advantage of the market, so I'm not saying that the numbers, if it's savings, you take on something that you are not prepared for. And you are not able to afford. So that's not the point. But the point is the buyers who are able to make that move are going to save this number over here depending on what type of home you're buying. So then for freehold townhouses, the average price was just over 1.1, and now it's sitting at just over $1,042,000. That is a saving of 6.9%. Condo townhomes, same thing. They were costing about $909. Now the average price for condo townhomes is $791. That's a saving of 12.96%. That's how much the prices have gone down since then. Condo apartments, on average, they were costing about $789, and now the average price in the slow market is $702. Again, that's an average saving of 10.26%. So these numbers can definitely make a difference, and many of you out there who are sitting on the sidelines, something that you should consider and take a look at. So notice that once the market peaks again, the prices will go up, and that could very well mean for you that you will end up paying a lot more for that same house that you can pay less for in this market that we're in. And I did a recent video where I broke down the numbers to monthly mortgage payments to really show you what the savings will look like for you, and I highly recommend that you watch that video. The link is somewhere on the screen here. And what I'm going to say is that this window where you can make that saving is not going to be open for too long, and it's actually closing, and it's going to close very soon. So I believe if you're someone who's waiting on the sidelines, this is the time to make that move. If you like this video or you like content like this, please do not forget to subscribe, as it encourages me to keep making this video, bring this information forward to you, and keep getting better at it. Until next time, have yourself a wonderful day. This is Frayal signing out.